Today I'm going to address once and for all for you why these stocks have came crashing down. These are some most popular names: Netflix, Tesla, AMC, SEA Ltd, which I'll highlight later to illustrate to you valuation methods, DraftKings and Palantir. And before we get to valuations, of course we need to understand this question of interest rate, correct? And I've actually prepared some interesting quotes from Warren Buffett. He mentions that the value of every business, the value of a farm, the value of an apartment, the value of any economic asset is 100% sensitive to interest rates. The higher the interest rates are, the less that present value is going to be. Every business, whether it's Coca-Cola, Gillette or Wells Fargo, its intrinsic valuation is 100% sensitive to interest rates. Here's also a further quote. Interest rates basically are to value of assets what gravity is to matter. Now these are very scary words, correct? If interest rates were to go up, what would happen? Will these high-flying growth stocks start crashing down? Today, we're going to run through a case study using SEA Ltd and I'll give you full numbers to illustrate the process. With that, let's roll in the intro video. Hi guys, welcome back. Today, let's use SEA Ltd as a case study to really understand how valuations and how interest rates really impact a high-growth company. Let's look at some latest numbers from third quarter 2021 for SEA Ltd. You realize that its expenses have been increasing, correct? Cost of revenue gone up. Sales and marketing expenses gone up. G&A expenses gone up. R&D expenses have also gone up. That has resulted in a net loss that has widened further in third quarter 2021, totaling $571 million US. With this as a starting point, let me share with you how valuations actually work and how interest rates really impact numbers. Because there could be a reason why the stock price have been falling so badly. Let's look at this valuation matrix which I've created for you. You realize over here that WACC, weighted average cost of capital, is actually the cost of equity and debt. Now as we know, debt is obviously linked to interest rate, correct? But cost of equity is also in many ways. But let's put that figure at 1% because previously interest rates were super low and were destined to stay there for quite a long while. And as we move, I've actually inputted some numbers for you to understand SEA Ltd's valuation. Just now we said that SEA Ltd lost $570+ million in third quarter, correct? And let's extrapolate it for a year, which means in 2022 year 1, they would lose $2 billion. All these numbers are in billion. Now the next part to look at, of course, is next year's projection. And assuming SEA Ltd is still trying to expand rapidly, it's a high growth company, correct? Expand at all costs. We realize that losses could widen to possibly $3 billion. And finally, or rather hopefully in 2024, year 3, SEA Ltd is able to turn a profit, milking some of its expansions in South America and stuff to become finally a profitable company. I've inputted 1 billion in terms of earnings. And subsequently, SEA Ltd is going to fly, growing its earnings 3 times and then subsequently doubling its earnings again to end 2027, which is year 5, as a 6 billion earnings company. And let's use a 20 times earnings multiple as a terminal value because at that point of time, SEA Ltd has future earnings that we need to discount also. And 20 times earnings is still a very reasonable price to pay for a growth company. So let's look, discounted earnings, if we use WACC at 1%, would be this following string of numbers over here, which gives a full value of SEA Ltd at $119 billion US and a stock price of $215 per share. Now let's see what happens if we were to increase the weighted average cost of capital because interest rates have gone up, correct? Let's input 5%. You'd see that what happens? The discounted earnings have all dropped significantly, correct? This whole string has reduced, resulting in a full valuation now of $97 billion, stock price of only $176. Just now it was $215. And if we fear interest rates really might spike up very high, let's input a weighted average cost of capital of 8%. What happens to our discounted earnings? You realize that these numbers have reduced even further, and especially the terminal earnings, that is the big component, correct? That means SEA Ltd now only has a full valuation of $84 billion US and a stock price of $152. Now let's check on 25th January 2021. That looks to be about the price that SEA Ltd is weighted today. So what can we learn from this quick example? Is that interest rates does impact the cost of capital, correct? And if the cost of capital increases, the future earnings or the future cash flows, if you use that other method, would subsequently drop, which means the valuation of the company would drop. And right now in the market, everybody is fearing interest rates going up. But I'd like to pause here for a while. What I've came to realize in a lot of ways is when you do valuations, there are a lot of assumptions to things. You don't know the future, and that's why I only put 5 years, because 10 years in the future, we really cannot expect things to be very clear. And what I need to caution when using valuation matrix is it's usually garbage in, garbage out. Let me show you more examples. If now we view the terminal earnings with a different multiple, say 30 times instead of 20 times, what happens is the valuation of SEA Ltd increases, correct, to $125 billion, and the stock price fair value becomes 226. And a lot of ways when we think about growth companies, we always associate with Amazon. And Amazon is really an example whereby its earnings previously was negative, but then once it turned positive in 2023, it skyrocketed. And if we look at a further graph, you'll see that Amazon right now does a way bigger revenue and profit number compared to its younger years. And not just that, if we were to believe SEA Ltd can grow very aggressively, we can even change year 5 projections to become $8 billion. And what happens is that stock price goes up to $302 per share. Now that inherently is a problem because when it comes to valuations, it's very much an art. It's not just punching in numbers. The art is deciding and tracking the business growth. And when market is generally favoring a sector, it's usually going to be a case whereby they are going to pay a higher price earnings multiple to things. You see something called a price earnings expansion. This is a concept that I teach in my investment course. So if you're keen to understand me better on how to research and do valuations to a company, check out my course links below. All proceeds will be donated via the Georgetown bursary. What else can we use to input to explain this whole decline in stock price for SEA Ltd? And is there any reason to be less optimistic or not? If we see the latest earnings again, there could be. This is regarding Garena, its gaming segment. And you realize over here that third quarter was actually the slowest growth in terms of quarterly active users and quarterly paying users. And that is really the bigger learning point. Tracking the business is actually more important than tracking interest rates. Again, I'll quote from Warren Buffett. There's nobody's predictions on interest rates I'll pay attention to. Even myself and even Charlie Munger. Don't waste any of your time paying attention to interest rate news. In any case, in previous Fed rate hikes, as you can see in this table, stock market in general has reacted positively. If we see from history, 2018, 2019, interest rates were way higher than what it is today, but markets were also bullish. If we flash back to 2006, 2007, before global financial crisis, you realize that interest rates was at 5.25, yet stock market was at a all-time high back then. Interesting findings, correct? So if that, help me smash the like button if this has benefited you, and together we can reach a bigger audience together to really educate investors worldwide on how to really approach stock markets and interest rate news a lot better moving forward. The key message that I'd like to end off today's discussion is when a market crash happens, the drawdown becomes very painful. Nobody loves losing money. And in general, everybody's assumption about future starts to become too conservative. What I would like to encourage each and every person is to don't convince yourself to find another way to grow your wealth. Convince yourself and practice becoming a more prudent and more patient investor, because ultimately when markets crash, that is when opportunities surface. So again, if you agree, smash the like button and check out some of the previous videos I've done before on investment behavior. These can help you a bit further in your investment journey, and I'll see you there too. Take care and goodbye.